Hi everyone, welcome to my channel. Today I'm going to tell you the essentials when you're trying to apply for a company loan. So your loan might be to either buy a vehicle, a passenger vehicle, commercial vehicle. For those of you who are in trucking, it could be to buy a haulier, a truck, or even to buy a mortgage bond, a house for you and your family. It could even be for machinery if you are into manufacturing. However, several things are pertinent and they are key, and I'd like you to take note of these. The first thing is the bank needs to see affordability. So your financials need to show that you've made a profit, and not just in the current year, but in the previous years as well. This will be backed up by financials, and of course they look at your cash flow statement. Now remember, your financials, we talked about this in a previous video, is made up of several things. You've got your statement of financial position, which shows your assets and your liabilities. You've also got your statement of comprehensive income, which shows your actual profit, your turnover, your expenses. And then you have the statement of cash flow. Those are the most important parts of the financials. And the banks or the funding institution will be quick to look at these, to look at ratios, and be able to tell whether you are a good candidate or not. So we said number one, affordability. Number two, they will look at risk. How risky would it be for them as an institution to lend you the money? Are you likely to be able to pay it back? Are you heavily indebted? Do you have other loans to other institutions? And how well have you been paying? Do you have a good credit record? And of course, they look at the assets on the statement of financial position. So worst case scenario, if you failed to generate enough income, would you be able to sell some assets and pay off your debt? Do you have debtors that you can call on to pay you? Or are your creditors exceeding or higher than your debtors? Once the bank is satisfied that number one, you can afford it and you're a low risk client, they then look at other things, and we talked about gearing, we talked about issues of solvency, whether or not your assets are higher than your liabilities. They may even ask to see several years financials just to see the trend. And they'll obviously need to see your bank statements. Why? Because some people do things on the financials that make them look good. They inflate their turnovers, they decrease their expenses. But as long as the bank has possession of your bank statements, they're then able to see whether the financials are a true reflection of your company. What you need to be aware of is normally they look at the bottom line. Have you made a profit or not? If there's a profit, they will then say, well, if our repayment of whatever asset is being purchased, the loan, is for instance 40,000 Rand a month, and this is your annual profit, does it cover that repayment and leave you with a surplus? Because of course, remember, you can't utilize all your profits into paying off an asset. You need to reinvest, you need to invest, you need to do so many other things. So that is where the affordability aspect comes in. They look to see if your profit allows you to pay off your debt. They will also look at future cash flows. Now we will do a different video and talk to you about cash flows. But in essence, they want to know, going forward, will the company continue to generate the same amount of income, same expenses, same profit, or do they intend to increase in profitability? And do the forecasts show that they will be able to pay off? Because remember, this debt is not a short-term debt. It may be a 5-year or 4-year loan. Or if it's a bond, then it's even 25 years, 30 years. So they need to know, looking into the future, are you going to be able to pay them? Make sure whoever prepares your financials, number one, they are an accredited a certified accountant with a practice number. And of course, the banks are likely to phone the accounting body and check if that person is in good standing, the accountant then signed off your financials. You may find the banks want audited financials or independently reviewed financials. They may not be satisfied with just a normal compilation, a normal set. Why? Because audited financials give them that extra assurance, that extra comfort. However, if you are not a very huge entity, in other words, there's what we call the PI score. If your PI score is less than 100, ordinarily there is no need for you to prepare audited financials. But the financial institution has the right to demand that you give them audited financials. So join me as I discuss these and many other interesting topics on my channel.